Hi everyone, welcome to my channels. I'm Doris. I'm here to share with you about my stock account and today's market updates. Right now, the net asset of my account is $72,443.61. Today's PL is a loss of 0.09%, and the current position is a loss of $1,950.17. Today, United Natural Gas closed with a loss of more than 6% during the market, and in the post-market, it closed down a further of 1.17%. Today, SPY closed up 0.023%, and SQQQ closed down 1.12%, and Apple closed up 1.46%. Today, the industries generally stayed within the range of fluctuations. Dow Jones Industrial Average closed up 0.1%, Nasdaq closed up 0.3%, and S&P 500 closed up 0.18%. The market generally posted a slight gain, but the variance in the industries have varied across that. The internet and the consumer and healthcare industries generally closed with a gain, whereas the financials and asset and energy resources industry generally closed with a loss. Today, the market generally focused on bonds and U.S. stock earnings that has been continuing for the past few weeks. Treasury yields rose again on Monday, with the 10-year yield up 9.1 basis points to 4.649%, after rising as high as 4.668%. The rise in the Treasury yields has limited the gains in the U.S. stocks. The Treasury yields climbed to a multi-year high after a few weeks ago, as investors prepare for the Fed to tighten monetary policy for an extended period. History suggests that this pattern tends to negatively affect the stock market. The yield on the 10-year Treasury note fell sharply on Friday to below 4.5%, but it still showed a sign of rebound today after we seen that it rising back to 4.6%. However, it is still a slight less of a margin of increase that maybe the top that it hits for above 5% a few weeks ago may be the peak for this whole rate hike cycle, and that the three major U.S. stock indices rose strongly last week, with the S&P 500 up 5.85%, its biggest weekly gain in nearly a year, after the comments by Jerome Powell and signs the cooling of the U.S. labor market. However, Wall Street short sellers still warn that the lack of technical and fundamentals support for last week's rally. It is hard to be excited about the year-end rally, and amid bleak corporate earnings prospects, weak macroeconomic data, and deteriorating analyst views. He said that the rally looks more like a bear market rally than the start of a sustained rally. He said the fall in the Treasury yields is more related to the lower than expected issuance and the weak economic data than positive, optimistic reading that the Fed will cut interest rates early next year. And other researchers suggested that the rally could be short-lived because the stocks don't fully reflect the prospect of interest rate remaining higher for longer. And right now, with the labor costs rising and the many companies' financials showing a lower financial earnings forecast for the future seasons, that the U.S. stock market may experience a tougher environment in the months following. This week's bond auction will play a crucial role on for the CPI data that's due later this month, and it'll be decisive and could possibly completely eliminate the possibility of the Fed raising interest rates again. The trend this year so far has been that the lowest 3.0% of CPI reached in July has shown a trend of rebound in the second half of the year, and the U.S. stock market and the Fed are all looking for signs for the CPI to show a sustained cool. This is all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.